The strange part is not the noise around silver, it is the silence before the next delivery test. May 11th could be the day that silence turns into proof. And once proof shows up, this market may never feel normal again. If you like seeing the crack before the crowd hears the break, subscribe now because this story is hiding behind numbers most people never look at. Silver looks small until you remember where it lives. It is inside solar panels, electronics, medical tools, batteries, defense systems, and the wiring of modern life. So when silver starts acting wrong, this is not just a story about traders arguing over price. It is a story about stress moving through the real world. That is why this matters more than a chart. Most people think silver is just another metal with a price that goes up and down. But silver is not only a thing people save, it is also a thing industry burns through every single day. And that creates a dangerous problem. When a metal is both money-like and machine-like, two different worlds fight over it at the same time. One side wants protection, the other side needs supply. Now add one more layer. For years, the world has been using more silver than it replaces. That does not mean every shelf went empty overnight. It means the cushion has been getting thinner while demand keeps leaning on it. So May 11th is not scary because the calendar is magical. It matters because dates like this force the system to stop talking and start proving. A market can survive on confidence for a long time. But when delivery pressure rises, confidence has to show metal, not words. To understand that, you need to understand COMEX in simple English. COMEX is a big futures market where traders buy and sell silver contracts. A contract is a promise tied to silver, and in some cases that promise can turn into real delivery. That sounds clean, until too many people want the real thing at once. Inside that system, not all silver is equal. Some silver sits in warehouses but is not ready to move against a contract right away. Some is listed as ready for delivery, meaning it can satisfy a claim fast. That ready-to-go pile is the part that matters when pressure hits. If this already feels bigger than a metal story, are you subscribed to the kind of channel that follows pressure before it becomes panic? Here is where the risk begins to grow teeth. If the amount of silver ready for delivery keeps shrinking while paper claims stay huge, trust starts doing the heavy lifting. And trust works great right up until the moment it doesn't. That is how quiet systems break. Think of it like airline seats. If an airline sells a little more than it can handle, most passengers never notice. But if too many people show up at the gate on the same day, the problem is no longer theoretical. Suddenly the system has to choose who gets a seat and who gets an apology. Now imagine that with silver, except the stakes are bigger. Factories need it, investors want it, institutions track it. And if the market cannot move enough real metal when asked, price discovery itself gets shaky. That means the posted number on the screen may stop matching the true cost of getting actual silver in hand. This is one reason refinery trouble matters so much. People often focus on mines, but silver does not become exchange-grade bars by magic. It must be processed, cleaned, shaped, verified, and moved through a chain of specialized facilities. If that chain slows down, the whole market feels tighter, even if ore still exists underground. And some of those processing points have already shown strain. When major refiners cut back, pause, or change terms, the effect is larger than it sounds. This is not like one store closing on a busy street. It is more like a traffic jam at a narrow bridge everyone forgot was essential. The real danger is that pipeline stress does not stay in one place. Metal backs up upstream. Buyers wait downstream. Contracts still trade, headlines still move, but the middle of the machine starts coughing. That is when the paper market and the physical market begin to drift apart. If you want more breakdowns that turn market noise into something you can actually use, should you already be part of this channel? There is another piece most people never hear about, and it may be the most important one. A lot of silver movement depends on financing, meaning someone fronts money so the metal can be carried, processed, and delivered. If that financing gets tighter, smaller operators do not just feel pain. Some of them stop functioning the way the market expects them to. That kind of squeeze can happen fast. 1 month, everyone acts like the system is stable. Then borrowing costs rise, lease rates jump, and suddenly holding physical silver becomes expensive and precious at the same time. That is a bad mix for a market built on smooth flow. When lease rates spike, the message is simple. People who have real silver want more reward before they let it go, even for a short time. That usually means the easiest bars to source are no longer easy. In plain language, the market starts paying up for immediacy, and immediacy is everything in a stressed market. A promise for later is not the same as metal today. A low chart price does not help if the bar you need is hard to source, delayed, or suddenly more expensive in the real world. That gap is where crises are born. This is why silver can look calm on a screen while pressure builds underneath. The paper market moves on trades, expectations, and positioning. The physical market moves on shipping, refining, inventory, contracts, and actual possession. Most of the time those two worlds walk together. Then stress pulls them apart. If you care more about what is true than what is trending, Have you joined the people here who keep looking below the surface? Now let's talk about the bigger background, because this did not appear in one week. For years, silver demand from industry has stayed strong. Solar growth alone has changed the conversation, because silver is used in the electrical paths that make panels work. The more the world builds energy hardware, the more silver matters. Electric vehicles matter too. Advanced electronics matter. Defense demand matters. Medical uses matter. None of this means silver disappears tomorrow. But it does mean the old idea of silver as a sleepy metal no longer fits the world we live in. When a resource becomes more critical to technology and infrastructure, every supply shock becomes more meaningful. The metal starts acting less like decoration and more like a pressure point. Then there is geography. A large share of refining sits in a limited number of places. A large share of mining also comes from a limited group of countries. That means the market is not just tight, it is concentrated, and concentrated systems are efficient until politics enters the room. If major countries decide strategic materials should stay closer to home, the global market loses flexibility. The backup plan becomes weaker. What looked like one big pool starts turning into separate regional pools with different rules. That is a serious change, because global prices assume metal can move where it is needed. If export limits, licensing, delays, or local priority rules slow that movement, price gaps can stay open longer than they should. That is a warning sign, not a footnote. If this is changing how you see money, scarcity, and trust, why not subscribe before the next stress point gets called a surprise? One of the clearest warning signs is backwardation. That word sounds technical, but the idea is easy. It means silver available now can cost more than silver promised for later. The market is saying today matters more than tomorrow. That is not normal for a comfortable supply chain. Usually the future price carries a little extra for time, storage, and financing. When the present starts beating the future, the market is revealing anxiety. People are willing to pay for certainty right now. Another warning sign is when price gaps between regions do not close quickly. Under normal conditions, traders move metal from cheaper places to higher-priced places and lock in the spread. That keeps markets connected. When the spread stays wide, something is blocking the usual repair process. Maybe it is shipment delays. Maybe it is tight supply. Maybe it is export control. Maybe it is a shortage of deliverable bars in the right place at the right moment. Whatever the reason, the message is the same. The clean global silver market people imagine may not be as clean as they think. It can fracture into pockets where one quote says one thing and real sourcing says another. That is how trust starts to split. So why does May 11th sit in the middle of this story? Because certain dates force positions to matter. People who were happy trading exposure suddenly have to decide whether they want cash, rollover, or real delivery. That decision is where pressure stops being abstract. A lot of market stress hides during quiet stretches because most players never demand the metal itself. They trade the idea of silver, not silver in hand. But when enough participants want the claim to become a bar, the system has to prove its depth. That proof can be painful, and if that proof looks weak, the damage goes beyond one day. Because markets run on memory, once participants see strain, they do not forget it. They change behavior. They demand more margin. They seek delivery faster. They trust the screen less. If you stay for the part most people skip, maybe this channel is already built for you. This is what could break silver forever really means. Not that silver stops existing, not that every vault empties in one dramatic hour. It means the old way people understand silver may never fully come back. If enough traders, institutions, and industrial buyers conclude that paper silver is not the same as reliable silver, the market changes character. Price becomes less about broad confidence and more about access, timing, location, and form. A bar in the right vault at the right moment starts carrying a different value from a contract on a screen. That is a deep shift, and once a market crosses that line, it tends to stay altered. People build new habits around what hurt them. They hold more inventory, they trust fewer intermediaries, they pay attention to warehouse levels, they watch delivery notices, they track lease rates and local premiums. They stop assuming the quoted price tells the whole truth. This is also why the mainstream conversation often feels late and thin. Most coverage looks at the price move first and everything else second, but price is the smoke, not always the fire. The real fire is in the plumbing behind the market. If the pipes are narrowing, price can stay misleading for longer than people think. Then one day it catches up fast. And when it does, the move feels shocking only because the quiet warning signs were ignored. That is how hidden stress becomes public drama. If you want more stories that help you see the plumbing, not just the paint, are you already subscribed? Now let's bring this down to normal life, because this is not just for traders in suits. When a market built on confidence starts wobbling, it tells you something about the larger economy too. It tells you how fragile just-in-time systems can be. It tells you what happens when the world leans too hard on smooth assumptions. We live in a time when many systems look stable until they are tested. Banks look stable until withdrawals rise. Power grids look stable until heat surges. Commodity markets look stable until delivery matters more than theory. Silver sits right at that intersection of trust and function. That is why this story feels bigger than one metal. It asks a hard question. When the modern world depends on critical materials, how much slack is really left in the machine? And who finds out first when that slack is gone? Prepared people do not wait for everyone else to panic before they start paying attention. They look for stress where others see boredom. They understand that quiet markets can carry loud warnings, and they know a posted price is not the same as a solved problem. This is not me telling you what to buy. It is me telling you what to watch, because the people who lose the plot in moments like this are usually the people who thought the surface was the whole story. The surface almost never is. So what should you watch if May 11th gets close and the market starts tightening? Watch whether warehouse inventories that are ready for delivery keep falling. Watch whether nearby silver stays richer than later silver. Watch whether regional premiums stay stubborn. Watch refinery news. Watch borrowing costs tied to physical metal. Watch whether more players ask for delivery instead of easy settlement. Those signals matter more than dramatic thumbnails and loud opinions. If this channel helps you see the signal through the noise, why not subscribe before the next piece clicks into place? There are really only two broad paths from here. The first is that pressure cools, enough metal moves, and the system buys more time. That would not erase the warning, but it would postpone the reckoning. The second path is more serious. In that path, each stress point teaches the market the same lesson again. Inventory is thinner than expected. Delivery confidence is weaker than advertised, and real metal carries more value than paper exposure suggests. If that lesson keeps repeating, silver does not need one giant explosion to change forever. It only needs enough smaller shocks to rewrite behavior. That is how systems transform in the real world. Not always with one loud snap, but with a series of moments people can no longer explain away. May 11th could become one of those moments. Maybe not because everyone will remember the date, but because the market may remember what it had to reveal on that date, and markets, like people, are changed by what they are forced to admit. If the system handles the pressure smoothly, that tells us something. If it struggles, that tells us even more. Either way, the day matters because it asks the market to answer a simple question with real evidence. How much silver confidence is actually backed by silver certainty? That is the question beneath the whole story. Not is silver exciting? Not can the price go up? But can the structure still carry the promises built on top of it? Because when structure weakens, price is only the last thing to notice. First comes the tightening, then the delays, then the cost of certainty rises. Then one day the crowd looks up and says everything changed so fast. But it never changed fast. It changed quietly, piece by piece, while most people were staring at the wrong screen. That is why this moment deserves your attention. So remember the real point. May 11th is not important because a calendar says so. It is important because trust may have to step out of hiding and face a delivery test in public. And if trust blinks, silver may never be priced, traded, or understood the same way again. Stay close if you want more stories that help you spot the shift before the world finally feels the shock, and subscribe now, because the markets that change history rarely send a second warning.